Buying a home is often described as the best financial decision you can make, but every financial decision comes with a hidden cost. That cost is called opportunity cost, which simply means what your money could have earned if you used it somewhere else instead. When you choose to buy a home, you're not just choosing a place to live. You're also choosing to tie up a large amount of cash in one asset. That money can no longer be invested in other places like the stock market, where it could potentially grow over time. To understand whether renting or buying makes more financial sense, we need to compare not just monthly payments, but what happens to that money over decades. To do that, we have to make assumptions. No one can predict the future, so instead of guessing, we use long-term historical data as a reference point. For investments, this analysis uses a 10% annual return, compounded monthly. That number comes from the long-term average return of the U.S. stock market and includes good years, bad years, recessions, crashes, and recoveries. It is not a guarantee, and actual returns will vary, but it gives us a reasonable long-term benchmark to work with. Now let's lay out the specific numbers being used in this comparison. We assume a home purchase price of $650,000 with a 10% down payment, or $65,000 up front. That down payment is important because it represents money that could have been invested elsewhere, but instead is locked into the home. The total monthly cost of owning this home with a 30-year mortgage is estimated at $4,050. This number is not just the mortgage payment. It includes principal and interest on the loan, property taxes, homeowner's insurance, and an allowance for maintenance and repairs. These costs are assumed to increase at 3% per year, which roughly tracks long-term inflation and rising property expenses. On the renting side, we assume a starting rent of $1,800 per month, also increasing at 3% per year. This reflects how rents typically rise over time as inflation and housing demand increase. The key difference between renting and buying in this scenario is the monthly cash flow. Buying costs about $4,050 per month, while renting costs $1,800. That creates a monthly difference of $2,250. In the rent versus buy comparison, this difference is crucial because it represents money that could be invested instead of spent on housing. In this analysis, we assume that the full $2,250 difference is invested every month in a diversified investment portfolio, earning a 10% annual return, compounded monthly. This assumes consistent, disciplined investing over the full 30-year period, without skipping months or withdrawing funds. When you invest $2,250 per month at a 10% return for 30 years, the future value of those investments grows to approximately $5,575,549.76. The majority of that total does not come from the money you personally contribute, but from compound growth over time. Now let's compare that to the outcome of buying the home. We assume the home appreciates at 3% per year, which is roughly in line with long-term housing appreciation once inflation is accounted for. After 30 years, a $650,000 home growing at 3% annually is worth approximately $1,578,500. Because the mortgage is fully paid off after 30 years, the homeowner technically owns the house outright. However, if the home is sold, selling costs matter. This analysis assumes 6% selling costs, which covers real estate commissions and transaction expenses. After subtracting those costs, the homeowner's net equity comes out to roughly $1,484,000. When you compare the two outcomes side by side, the difference is driven almost entirely by opportunity cost. Renting while investing, the difference produces approximately $5,575,549.76, while buying produces about $1,484,000 in home equity under these assumptions. This does not mean buying a home is a bad decision. Buying offers stability, predictable housing, forced savings, and protection against rising rents. It also provides lifestyle and emotional benefits that cannot be measured on a spreadsheet. Renting, on the other hand, offers flexibility and the potential for higher net worth if the monthly savings are consistently invested and market returns are strong. The math only works if the difference is actually invested and left alone long term. The real takeaway is not that renting is better than buying or that buying is better than renting. The real takeaway is that time and opportunity cost matter. Over long time horizons, small monthly differences can turn into massive gaps in wealth, depending on how your money is used. The right decision depends on how long you plan to stay, how disciplined you are with investing, and which trade-offs matter most to you.